Life Healthcare is listing next week, and the view on equities following the recent sell-off are just a couple of the issues we're discussing today with RMB Morgan Stanley CEO Chris Meyer. Chris, thanks for coming in today. You managed to mix elegance with Football Friday over here, I see. Chris, let's start with the Life Healthcare listing. The price for the private placing given today at R13.50, a little bit below the R17 that was initially expected for the group.
Yeah, well, the initial range was actually 14.50 to 17. I mean, obviously with most IPOs, so. Yeah, look, it wasn't easy. I mean, I think it's a great event for the capital markets in South Africa, having such a high quality company of that size listed. It's a 14 billion rand market cap company at that price, R13.50. But you know, during the process, and I think you had the CEO Mike Fleming on your show a couple of weeks ago. You know, the market threw a few curveballs at us, there's no doubt. I mean, the sell-off in the markets, the volatility in the markets did result in investors being cuter on price and on size. And so, but I think the end result is a very positive one. I mean, it's a high quality company. I think investors have got a pretty good deal at that price. And I think the aftermarket in the stock, which will start trading next Thursday, I expect to be quite positive based on the book of demand that we saw come into the IPO.
And of course, following that listing next Thursday, of course, the market will really determine what the value this company should hold going forward.
Yeah, I think so. I mean, I think to some extent they've determined that today in that price. I mean, where we are today, that feels like the price that the market's prepared to pay.
Price they got for it, though.
Yeah, I think so. I mean, I think if you know, personally, if you take a company that's growing at 15% and gives you about a 3% dividend yield and it's on 12, 13 times earnings, to me that's a pretty attractive investment. And that's really what you get if you buy Life at R13.50. So, you know, I expect the stock to trade up. I'm not sure whether it trades up immediately given the market conditions where we are today, but I would expect it to track its growth rate over time. And I think that at 15, you know, in the mid-teens is a pretty attractive growth rate, particularly when you compare it to other companies on the JSE where you're taking a much bigger bet that the cycle recovers. Here, at least, you know, there's some good fundamental demand because the healthcare industry in South Africa is so underpenetrated. That, you know, ultimately the service providers like the hospital industry and Life being one of the big players there will benefit from the massive amount of demand that South Africa will need to provide for what is effectively a very sick population and a government sector that just cannot provide the facilities that the population needs.
And of course, this is a hospital group that is rated slightly higher than its peers that will be joining on the JSE. That's Netcare and Mediclinic, although they do have a lot more offshore exposure than Life Healthcare does, don't they?
Yeah, so they are slightly different. I think in terms of their South African hospital operations, you know, you could debate whether there's much in it. I mean, I think they all have very similar profitability and size and market share and all that sort of stuff. You're right, Netcare and Mediclinic do have offshore exposures, which gives them a bit of a rand hedge component. It's actually interesting, if you look at Life on a PE multiple basis, it's about in line with its peers, but because its balance sheet is so much less geared than Netcare and Mediclinic, when you look at other valuation metrics, it actually stacks up as being much more attractive than Netcare and Mediclinic. So I think, again, I think it's a pretty good investment at that price.
Just looking at the IPO markets at the moment, was there any point in holding off the IPO of Life Healthcare until the markets had improved? Although this is a defensive concern, I think we've discussed this in studio before, that a defensive concern like this, market timing isn't that important.
Market timing is always important, depending if you're a buyer or a seller, of course. In this instance, you know, we worked for 8 months on this transaction. It's quite difficult for the selling shareholders, the management team, you know, everyone who's got very fired up about listing the company to back away for the sake of 50 cents to a rand. But make no mistake, it was a negotiation. It always is in an IPO. You know, I would say if you look at the ultimate value of the company, which I think most of the shareholders still have some interest in, you know, it may well be north of where it is today in a year or two's time. And I think to some extent the selling shareholders were also focused on that, which is why many of them scaled back what they were prepared to sell at the lower price. What's
the IPO environment looking like globally at the moment?
It's pretty rough. You know, I think I saw an article in a publication called Financial News, which said 62 IPOs have been pulled, totaling $11 billion in the year to date. So that's a big number. You know, I would say in the last month alone, which is really when the markets have started to skid, about 3 of the 15 IPOs have actually gone ahead. So this is one fairly unique event that we managed to get this IPO away in a market where most other IPOs globally are being pulled.
And of course, there was some foreign interest in this IPO, wasn't there?
There was. About 25% of the demand came from the foreigners, and so 3/4 came from South African investors. I think a very good sign again that South African investors are still very engaged in the market. And then the split between hedge funds and long-only funds was also about 75% long-only, 25% hedge funds. So again, I think a fairly typical balance from the ECM or equity capital market transactions that I've worked on. That seems to be about the balance and a good balance between foreign, local, hedge fund, long-only.
When would you see the market becoming a little more conducive to listings?
That's a very good question. I mean, I think there is cash on the sideline. So there is cash waiting to be invested in the market and in new ideas like IPOs. I think what we experienced in this transaction, and I think what anyone who's trying to bring a company to market in this condition would experience, is that because the volatility in the market is high, the foreign investors in particular are expecting a much higher discount on IPO and aren't really prepared to put in order sizes at the same extent that we would expect from them in an IPO. So you're typically finding foreign institutions that could write $50 to $100 million order size tickets are probably in for more like $10 to $20 million in this environment. And they're obviously much more price sensitive. So as soon as the global equity market environment improves and they feel better about their portfolios in Russia and Brazil and China and wherever other emerging markets that they're invested in, I think you'll find that the price sensitivity and probably some of the volume will come back into the market, particularly as the hedge funds leverage up again and the long-only institutions are prepared to invest the cash that they're sitting on at the moment.
And of course, private equity companies have also been under pressure over the past couple of years. So has that perhaps delayed their exit strategies from companies they might want to relist on the JSE?
Yeah, absolutely. I think so. I mean, it's a trade-off for a private equity firm between price and timing. There are certain time limits on when a fund needs to realize an investment in a private equity fund. But absolutely, I think at the moment you're probably finding they're tending to rather take a bit more time to realize a better price than proceed right now, which is why many of those IPOs have been pulled. Partly because the perception is the demand won't be there, or the expectation is the demand won't be there, but also because the seller's price expectations won't be met.
Well, you mentioned the market volatility we're seeing at the moment, and it's really continued over this past couple of weeks. And JSE today swinging between positive and negative. Yesterday, a great big swing as well. What are you doing at the moment? What would your advice be with equities? Do you think it's time to go in there looking for bargains? Do you think we could still see a further pullback?
Yeah, look, our equity strategists globally actually think it's a pretty good time to start buying the equity market. And they think it's more like what we've seen recently with the sell-off is more like 1998 type sell-off, where you did have sovereign risk concerns, you did have LTCM, but it was a growth scare. So the markets got concerned that growth wouldn't come through as strongly as people expected. But as the market fell and growth actually did start coming through, and the sovereign crisis didn't permeate into something more material, the markets recovered very quickly post 1998, if you remember. And so they think it's unlike 2008, where obviously you had Bear Stearns going to Lehman Brothers and the whole thing kind of corrected quite sharply. So I'm a little bit more, I'm not sure. I don't think we're quite out of the woods yet. I think we could see another 10% correction in our markets. And I think in that process, investors should be looking for good quality companies that are sold off irrationally. And I think you will get some of those if we get another 10% fall in the market.
So it's back to that whole theme of a stock picker's market at the moment, really looking for those bargains.
Yeah, I think so. I mean, the equity markets are reasonably priced. They're actually bordering on cheap in certain markets.
South African markets as well as global markets.
I think more actually global markets. Europe, the UK in particular, are the ones that have taken the most brunt of the sovereign risk for obvious reasons, because that's where the sovereign risk resides. But if you look at the UK market, I mean, it's even in emerging markets, 10 times earnings is not a bad multiple to pay for a stock market when your 20-year average is probably 10 to 13. And interest rates at the moment, which are so low, would support actually a higher PE multiple. So I don't think equities are expensive. And I mean, again, I think what we're going to find going forward is that dividends will actually give investors a higher percentage of their returns going forward than some big re-rating in the PE multiple of the market. So I would look for high dividend yielding stocks that have a reasonable amount of growth. And again, back to life, I think it fits that bill pretty well.
We'll be watching that next Thursday then, won't we?
Good.
Chris, we have to leave it there. Thanks very much for your insights this afternoon. Stephen.